in business, you take all of it home. You put it back in, don't you? At least a large part of it. You got to put it back in to build the business. This is no different than any other business. You got to keep that money there. That's how I took the $10,000 to $1.1 million. I always traded about 80% of my capital, because I assumed more risk, was at risk at the market. Sometimes 100% of the capital, all the time. As I made more money, I had more contracts. When I lost money, I cut back. If I was down and I couldn't trade 100 S&Ps, I had to cut back to 50 S&Ps, to 20 S&Ps. I had to cut it back. As I made more money, then I continued to increase the number of contracts I had. So the bottom line is you're going to increase the number of contracts as you make more money, decrease it as you lose money. And a general operating rule that's safe for most of the public is about 30% of your capital can be in the market. Sitting on 70% cash. Now I know you're greedy and you want to make more money than that, but play it safe if you would. At least until you've been around 30 years like me. Then you can go up to the higher numbers. But for now, stay with about 30% of your money in the markets, whether, especially if something speculative is commodities. In stocks, it could be a little higher. It may not be quite as speculative. But you don't overstay your position. People get in trouble because they take too much risk. They expose themselves to too much risk in this business. You don't have to do it. The volatility, the risk is you determine it by how much money you put on the table. And you don't want to put up 100% of your money. Put up about 30% of your money. If you're just starting, 20% of your money. Now people say, but Larry, I only have $1,000. I can only trade $200, $300. Well, there's a case where probably an option is what you're going to have to use. Or you're going to have to increase your risk. And people say, well, I only have $1,000. I don't want to lose $1,000. Well, yes and no. If I was to say to somebody, let's assume, for sake of argument, that your net worth is $100,000. That's all that you own. That's everything. I'm going to say to you right now, I will flip you heads or tails. For $1 million I'll give you, or I get your $100,000. Is that a good bet? You'd take it. I'm going to take your wife's wedding ring. I'm going to take your cars. I'm going to take everything you've got. And you've got to earn $100,000 over again. That's probably not as good of a bet as if you were only worth $1,000. Because you can get $1,000 easily. The people who get into trouble in this business are people who come in with $600,000 to trade pork bellies. And suddenly they've lost $300,000. They're way behind the 8 ball, and it's hard to get $300,000. But if your grub stake is $1,000 or $2,000, you can earn that again. That's not a problem. So I think it's wiser to start, and you can assume more risk, strangely enough, if you have small money. You lose $1,000, $2,000. Well, that's going to come back to you in your lifetime. But if you come in with $300,000 or $400,000, that's a different ballgame. I taught a guy in Hawaii years ago how to trade. He had lost a huge amount of money, gargantuan amount of money. So a brokerage firm flew me to Hawaii to have me teach this guy how to trade. I spent a week with him. Wonderful guy, great wife. She said, oh, the Asian couple, you must teach Harry to trade. He lose all money. So, yeah. And they were so kind, just so gracious. Showed me parts of Hawaii I'd never seen before. After the week's through, on Friday we got our first trade. Soybean oil. Now there's about as dead of a market as you could trade. He'd been trading pork bellies, like 80 pork bellies at a time, 80 to 100 contracts. So we get a trade in soybean oil. At the end of the day, he's made $1,200. And I go, yay! He's so happy. He's been used to losing $20,000 a day or making $10,000 a day. He turns to his broker. He says, $1,000, $1,200 is not much money. Get dice. I roll double nothing. He and his broker rolled double or nothing for the $1,200. That's the personality that most of us have, part of that inside of us. I'm like, wow, I think I failed teaching this guy, right? He taught me a lot, though, I'll tell you. And you have to be careful of that part of your personality. Say, hey, I can take some risk, but you don't want to lose everything. But if your everything is relatively small, something you can earn back, sure, that's fine. And you got a better shot coming in the market with a couple $1,000 and a bigger stop, percentage of your capital, than the guy who comes in with $600,000 and he's going to risk 50%, $300,000. That's hard to get back $300,000. Getting back 80% of $1,000, sure, you can earn that back one way or another. You can go on welfare probably in California and get it back in a couple of weeks. So, well, 3 weeks actually. So that's also a way I look at risk reward, is what is my bank and what is how do I determine that? But to maximize your money, you want to keep a certain fixed amount invested. The other thing, though, that is equally important when it comes to money management is this. ultimately, this game is not about winning and losing. It's not about building up a big equity in your account. This game is about drawing money out of your brokerage account. And they don't want us to do that. They don't want us to take money out of the brokerage account. And we kind of feel guilty. It's like it's a bank account in a way, a savings account in a way. And, you know, have you ever noticed that? You hate to call your broker up and have them send money to you, right? We've all felt like, you know, you feel awkward doing that. It's your money. You know, you're entitled to it. Call them up. Send it all out. It feels good when you get it. But we tend to overstay our position, greed again, if you will. I've noticed it because this has happened to me. You've got to draw money out at some point. So you say, hey, my goal is to make $5,000 and I'll pull out $2,000. My goal is to make $10,000 and I'll pull out $3,000, whatever it is. Have some goals for yourself to pull money out, because the object of this game is taking money out of the brokerage firm account. And they want you to keep it all there to keep trading because they make more commissions. They're not out to hurt you. It's just their vested interest is commission. Our vested interest, pull money out from the brokerage firm. And most of us, just once the money is in the brokerage firm, really, a lot of people, I think, just say in their mind, oh, what the hell, I lost it. It's still there in the firm, but now, you know, they don't need it to live on, so they just kind of, they dabble it away. That's play money. People call me up all the time, well, I'm just playing the market. Oh, you are? Really? You know, I'm serious about this stuff. You want to just play, send your money to me. Gladly. I mean, at least you'll know where you lost it. You don't know where you lose it when you play in the markets. This is serious business. So you need to have a mental attitude. The object of this game is to take money out of that brokerage account. That's the object, the single sole object of this game. And once you get in tune with that, you're going to start calling up your broker and say, send me, even if it's $500, send me out $500. You know, take money out of that account. That's how you stay ahead in this game. And the opposite side of that coin is you do need to keep some money in there to continue the growth of the account, to get the large extrapolations that I've been able to do. My best actually wasn't the 10,000 to million. I took $2,000, like $85,000 one time in about 8 or 9 weeks. And that was the same thing, just, you know, putting a pedal to the metal, so to speak, and continuing to increase the size of the positions that I had. So that's how you get large, rapid growth in your equity, but that swings both ways. And you got to take money out of that account. Well, it's great when I took the money out of the $1 million. That was a wonderful feeling. We said, hey, that's it. I'm through for the year. Let's close that account up. Let's close on some of my favorite trading patterns for you. Some of the biases that I found in the marketplace. And let me show you what those are. Some of my very favorite trades that I'm going to show you now. I'd like you to look at this. There are options on stocks, and they expire once a month, the third Thursday of every month. And what I've noticed is an interesting thing about this option expiration. This is option expiration, but look what happens from the Friday prior to option expiration to that option expiration. The market rallies. Friday to the next Friday, rallies. Option expiration, there was a previous Friday, it rallied. Option expiration, bought on Friday, it rallied. Option expiration here, there's the Friday prior, it rallied. Option expiration here, there was Friday, it rallied actually Monday and Tuesday. Option expiration there, oh, you bought Friday, it rallied. That's pretty remarkable. Look at another chart of this. I think I've got another chart here someplace. Yeah. See if we're in the same market in the same time frame. Yeah. Here's option expiration again. Option expiration is here. We rallied on Monday. Option expiration there, we rallied all week long. Option expiration was here. We rallied from Friday up to Thursday. Option expiration there, we rallied that week. Option expiration here, we rallied a little bit on Monday. That was it. Option expiration here, you bought there. You got a nice rally the coming week. Here's the rules for you. The rules are real simple. We're going to buy on the close of the Friday prior to option expiration. That's the entry rule. So I can tell you right now what I'm going to do in December. I'm going to buy on the Friday, on the close, Friday prior to option expiration. And I'm going to exit on the first profitable an X on the first profitable close. The first time I have a day that closes profitably, I'm going to get out of that trade. Usually it's going to be on Monday's close. Sometimes it'll be Tuesday's close. Or I'll have a protected stop loss, and my protected stop loss is going to be somewhere in the area of about $2,500. And let's see what that looks like. It's been 89% accurate. Average profit per trade has been $438. Made $71,000 from 1982 to 1996. Now this is interesting because we didn't have options in 1982. If we cut this off when the options got active about 1986, 87, we drop out a bunch of losing trades into almost 95% accurate. I first taught this 3.5 years ago I taught this. First time anybody ever heard about it. And in that 3.5 years, there's been 2 losing trades. It's really powerful. So the option expiration trade is a real moneymaker trade. It's in your seminar manual or in the Batting 800 book. You definitely want to pay attention to the option expiration trade. It's been a very good signal. Another bias for the marketplace is the one I briefly mentioned earlier about end of the month. There's been a phenomenon in the bond market. If you buy on the opening of the third to last trading day of the month and you sell to get out on the third trading day of the new month, this is what's happened to your equity. It's gone up a whole lot. And the rules are buying on the opening, the third to last trading day of the month, 3 days left to go you buy, and you get out on the close of the third day of the new month. And as you can see from the equity, that's been pretty successful. I can show you a little bit more about that now. This is Treasury bonds. We're going to exit on the close. $2,500 stop has made $42,000 trading the Treasury bonds, a couple $100 average profit per trade. There's a strong influence for the bond market to rally the last few days of the month and the first few days of the new month. Now this is just a hard, fast, mechanical rule. You could come up with all kinds of other stuff on your own to buy at a better price than I'm just randomly buying the close or the opening, whatever it is. That's all. Well, you can do some other things to fine-tune your entry into these markets. Those of you that have quote machines, that's where your quote machine can pay for itself. You can buy some weakness. You can fancy dance in and out of these markets, knowing we've got a bias here in this market, the end of the month and the first of the month. Interestingly enough, that bias, I'll show you some more data on that. The best rule that we came up with was use a $2,000 stop and take a profit of about $1,200, and that produced this equity curve. On its own, with no stop and just getting out 6 days later, was this equity curve. You had a bit of a drawdown in here. We increased the exponential growth from $50,000 to $68,000 by trading to a target of about $1,200 with a $2,000 stop. And you can do that if you want to, but just, you got a bias. You've got a huge advantage in the market. Stocks also rally at the end of the month and the first part of the new month. There's a good stock trade there as well. That's in your Batting 800 book. Well, in fact, I've got some numbers on that right here. For this rule, we're going to buy same time period, 3 days prior to the end of the month, get out 3 days of the new month, 6 days. So we're in the trade for 6 days. Makes $131,000. It's 54% accurate, $741 a trade. Drawdown was $11,000. You're Las Vegas. You're Caesar's Palace. You've got an advantage in the game. And they're not always going to win. In this case, about 60% win, 40% of the time you're going to lose money. But you have an advantage. You got a cow you can milk. And that's really my trading strategy, to find an advantage, get a contextual thing going, and then take these signals religiously as they come on a mechanical basis. In this case, because I know if I work that advantage long enough, I'm going to get rewarded from it. My attention is on following the system as opposed to how much money am I making. If I follow the system, I'll make the money. I use my stop, place my order, and I look for those biases in the marketplace. I'd like to close this with one of the most powerful signals that I've ever used, and that's going to be the oops trade. And we'll show you how we can make a oops even better. The oops trade is this. oh, it must have been 15, 16 years ago now, I noticed an interesting configuration in the marketplace. It was essentially this. The market opens tomorrow lower than today's low. And it starts trading like this. So it's very bearish to have that big of a gap of a down opening. If this market starts to rally back up to this day's low, buy. There's my buy signal right there. And I'll get out with bailout or a dollar stop, one or the other. You'll see time after time, this is how markets top and bottom. I can make a mechanical trading rule out of this in the S&P. Remember I said some days of the week are better than others? Well, in the S&P, the best day to buy on is buying on a Monday. So buying an oops on a Monday is just a wonderful trade. And I'll show you how wonderful can get in this business. In this case, I'm buying all oops buy signals except Thursday and Friday. So I take an oops on a Monday, Tuesday, or a Wednesday. 88% of the trades are winners. Makes $88,000. Profits of $5,000, a drawdown of $5,000. They've got extremely high accuracy. And probably one of the best trades to take every single Monday. I'm looking for oops. It may not occur, unfortunately. But if it does, I'm taking the oops trades. They're really good. You can make this even better, and I think we've got, if I can't readily access it here, we can also, oh yes, here it is. We can make it better by doing this. This is an oops buying just on Monday. In other words, Monday's opening is lower than Friday's low. But I'm going to put something else in conjunction with that. I'm going to say that the bonds must be in an uptrend. So if I've got the bonds coming up and I have a lower opening on Monday, if we rally back to Friday's low, I'm going to be a buyer. 91% of the trades have been winners. Average profit almost $1,000. $61,000 with a $2,500 drawdown. It's real good. And the interesting thing to me is over the years, I've taught oops literally all over the world. My favorite oops story was in a foreign country. And it was kind of grubby looking, and I'd got off an airplane and found a brokerage firm and went inside to get quotes. So I find a quote machine, and they're all talking other language, and I hear these guys off in the corner. This guy's got a crowd, and he's talking all about the markets. And he's a German guy. He says, well, my very best trade I'm going to show now. When market opens below Friday's low and comes back to Friday's low, that's the buy signal. And that's my stuff, This is like my children. I own it. I created this. And this guy's doing my stuff. And I walked up, and I just walked in this group and said, hi, I'm Larry Williams. This guy said, oops. So they said, oh, I saw your tapes. How are you? And all that kind of stuff. And, hey, it's mine. Give me credit at least, right? But that's one of my very favorite oops stories. It is, despite the fact that oops has been around so long, it still works. It works real well. I can make it a little bit better in some other ways as well. And on the advanced trading video seminar, you can see other ways of using this and putting things in conjunction with the bond market. But this is about as simple of a trade. The problem with the trade is it doesn't occur very often. It's only occurred about 6 times a year. Most of you don't have the patience. Or on those 6 times, on one of them your kids will be sick, on the other one you'll be on vacation, the third one you'll be afraid to take the trade, and the 5th one you'll be so angry you won't do it. You have to follow this stuff. You got to follow it. If you're going to do it, you got to stay with it. And if you do that and stay with the things that I've taught you, I think you can find success as a trader. And remember, we've looked at patterns now. Some of these short-term patterns, they're in your Batting 800 book. You can review those for short-term S&Ps, bonds, trades like that. You understand how to get in and out of markets, where your money management should be, and most importantly, the big guns that set up the markets for the big trades. And that's going to limit your field of vision. Instead of looking at 25 commodities, you can say, there's a couple of markets that are set up. I'm going to focus, put my blinders on, and focus on those markets now. I'm going to trade those with the stuff Larry taught me or the stuff other people have taught you. And then you should, your odds of being a successful commodity trader are going to be much greater than somebody who just walked in off the street. That's how you find success trading commodities. Being disciplined, doing the right stuff. Don't get too complicated. Don't get too complicated about it. And you do that, I think you're going to find success. I'd like to thank everybody here today that bared with me all these hours. And you at home, I'd like to thank you for watching, for purchasing the video, and I hope that in some way this exposure to Larry Williams has added a little bit to your life, a little bit of understanding about the markets, maybe there's some understanding about yourself as well. And most of all, to all of you, I wish you nothing but good luck and good trading. Wow, I admire you. Anybody who sat through 6 hours of Larry Williams videotapes, maybe 1 or 2 times already, read a book about that thick, you impress me that you're this far, that this is where you are. There's just a couple of more things I'd like to say to you. I think the best thing to do now is to what we call paper trade. Get some charts, get the information, and don't actually make any financial commitment to the market yet, but trade on paper. Get yourself up and running, keep your powder dry, so to speak, by just trading on paper without placing actual orders. By doing that, you'll get the confidence you need to get into the fire pits of trading. And once you've done that, you'll have the internal confidence that, oh, I know this works because I proved it to myself in advance. By doing that, you'll be ready to start trading full time. And if there's some things that aren't clear in this tape to you, get in touch with me. You can fax me at area code 619-259-1331. That's 659-259-1331, or call me at area code 619-756-0421. Just do me a favor, please. Don't call at 6:30 a.m. California time. That's when the S&P's open. That's my big market. Best time to probably reach me is between 7 and maybe 9 California time. And then again around 12 to 2. That's a pretty good time to get in touch with me, too. And if you have questions, like I said, call. I want to make certain that you're clear on what you're doing, because you do have good information. And if you have the clarity of that information, I think you're going to go out and make a killing in the market.